Welcome to the MSDW podcast. I'm Jason Gumpert, editor at msdynamicsworld.com. On this episode, we are talking about the factors driving the future prospects of Microsoft partners, and especially Dynamics partners. It's a complex subject, and I've invited Dana Willmer and George Brown of Partner Economics to join me. Dana and George have written a new article on MSDW and have also been presenting their latest research findings to members of the Microsoft partner ecosystem. Their findings, based on data they've gathered on partner sentiment as well as financial performance and forecasting, indicate a range of heightened risks to the traditional Dynamics reseller business model. The prospective negatives can pile up quickly: declining service margins, declining earnings, resource shortages, and increasing delivery costs. Add to that macroeconomic forces and changes specific to Microsoft's own channel strategy, and partner firms have some important decisions to make about the future of their businesses. Dana and George share more on what they have learned from their research, some of their guidance for partners today, and where they will be watching for the future. Okay, well, Dana, George, welcome to both of you. Thanks for joining me today.
Our pleasure, Jason.
Totally, Jason.
All right. Well, I thought maybe we could start with some introductions. I think for people on the partner channel, they might know your names, they might have heard you present or have met you, but can you, for our listeners, give us a bit of an intro on who you are and what Partner Economics is?
Sure. I'll get started here. So my name's George Brown. I've been in the ecosystem. I've been in the broader sort of ERP ecosystem since the late 80s. And I think I would probably say that the whole Microsoft Dynamics ecosystem has been my life's work over probably 25 or 30 years, and sort of invested in that and doing all kinds of project work there, both for Microsoft as well as partners. Today, with Partner Economics, what we continue to do is just provide more what I'd call advisory or management consulting service owners and shareholders of partner businesses. We do research, which we've done forever. We've always done the research as a way of providing good advice to the clients. And then we've also got involved in mergers and acquisitions. And that's just because of our relationships with the principals of these firms. So that's a little bit about me. Dana, I turn it over to you.
So I'm Dana Willmer, and I've been in the ecosystem not quite as long as George, but going back 15 years ago now. And really, my love is in terms of being a business analyst, I'd say. And I sort of developed that in the early part of my career in the investment business, did a stint there as a retail stockbroker and investment analyst before moving into this ecosystem. And so that's kind of been a passion that I've always engaged in. And I really have driven the research and financial analysis part of partner economics, conducting periodic benchmarking studies and things of that nature, as well as provided, along with George, consulting advice to literally scores now of partners around the globe, although most of our work is in North America and Europe.
All right, excellent. And, getting into, as you both mentioned, the research side of things, that was really what I think sparked our conversation and what sort of led us here to this conversation today. I was able to catch your presentation earlier this year at the Directions North America event. I know it's a set of findings that you've been sharing, in a few places, a few spots in the recent weeks and months. And I really wanted to talk about it a little bit more because I think it's raising some eyebrows, certainly in the partner channel. I would say not necessarily things that people are blindsided by, but sort of laying them out with some data, with some new findings from the channel itself. And I wanted to get into that. I mean, a couple of the findings that I'll just start with, and you can obviously add more to it, but you're seeing, service margins, software revenue declining in the partner channel and some other changes too. Can you start talking about perhaps that a bit, Dana?
Yeah, Jason. So there's certain sort of key metrics that we look at when we think about the median partner and where they're headed sort of financially in terms of their trajectory. And we sort of start by looking at growth. And across the ecosystem, the median level of growth is under 10%, just over 7%, in fact. Now, there are some partners that are doing better than that, those configured for volume, those monetizing more of their own IP. But in general, the growth is quite slow, certainly relative to the demand that we're seeing for cloud solutions. If we think in terms of the mix between services and software, we're seeing that ratio decline. It used to be well over 2% and was even close to 2%. If we think sort of before the pandemic, it's down to, 1.5 now. So for every dollar of software that you resell, the median is about $1.50 in services. We also like to track the percent of revenue that's comprised of own IP because that pretty significantly can impact the level of profitability. And the median level there is about 2.5% of revenue that's your own IP. And interestingly, if that number sort of gets to be 10% or greater, there's a pretty distinct impact on profitability. It typically ends up being double digits. Software and services margins, as you mentioned, are both under pressure, for different reasons. We can go into more detail in that in a moment. But if we look at the overall level of software gross margin, that's down to just under 31% and steadily declining really over the last since we've been tracking it, and particularly in the last, say, 5 years. Services gross margin also declining to roughly 33%, again, down from highs that we were seeing going back in time of, as high as 40, 50% in some cases. That still is achievable by some, but very, very few. And all of that sort of combines to, a level of overall profitability or EBITDA that is today for the median partner about 6.5%. And it's actually rare that we're seeing double-digit EBITDA at this point.
One of the things this makes me think of, and you touched on this, is that different types of partners are performing very differently. Is that something that you've been watching as part of kind of measuring this performance?
Yeah, I'd say there are two kind of configurations that we're seeing driving better levels of profitability. One would be what we would characterize as own IP based, or really giving customers a compelling reason to buy from you as a VAR rather than just, buy software and attached services. So where a partner has configured themselves to monetize increasing levels of their own IP, typically their profitability, almost invariably their profitability will be higher. And interestingly, if it gets to, let's say, a 10% threshold, so 10% of your revenue being comprised of your own IP, profitability is almost always in double digits then. The second area of activity where we're seeing better levels of growth and profitability are those partners specifically configured to ride, let's call it the cloud wave. So they're more of a share of wallet play, as we would say. So they're monetizing, they're capturing more of the customer's end IT spend. And as long as they're keeping operating costs relatively low, they're typically driving out, double digit levels of EBITDA or profitability.
Well, I think, Dana, just to add to that one, right? The other areas that we continue to see, double-digit EBITDA growth are in those firms that are very good at driving the leverage equation within the business, right? So there are a number of partners that are configured really around the services equation. They're very well managed, high utilization. They're still after the upper mid-market, so they have relatively good-sized projects. And those partners are also still making very good money, right? But that's also, there's not as many of those as there used to be, right? Where that traditional model used to, drive in double-digit EBITDA for everybody, it's now left to a very few that can really drive the leverage model equation within the partner business.
Yeah, totally true. And I would just add that there's really kind of three paths to profitability that we're seeing emerge. The first being monetizing your own IP, giving customers a compelling reason to buy directly from, not to buy directly from a publisher, which is often the customer's tendency these days. So if you have your own IP that you're able to monetize, you have a compelling reason for a customer to buy from you rather than just think of directly buying from the publisher. Second being focus on share of wallet. And third, as George describes, really dialing in your leverage model. Any of those three paths can lead to enhanced levels of profitability.
Yeah, I think I just make this as an observation. I see that partners impair their profitability when they try to mix the models together, right? So they either try to do an IP plus a high service ratio, or they try to mix a volume business with a very heavy services business. Whenever you sort of, I think, commingle those business models, it has a negative effect on EBITDA.
That's really interesting. And I did want to ask, as you've gathered these findings and presented them, what have you heard from the audiences that you've spoken to? Do partners, people running partner businesses, identify these same factors and say, yeah, that's where we're facing the tough decisions or where we're looking to change? Or is it really eye-opening for them?
I would say this, Jason. I would say that most of the people running partner businesses today are heads down driving the business forward, right? So they're not really they're not, heads up looking or scanning the market, trying to sort of operate this business. So I think, the general reaction is, what? We never thought about that. We were so busy doing our thing, we never thought about it. We didn't look at it. And, that's one of the reactions we get. The other reaction we get, this could potentially sound negative, but there's this shiny object syndrome. You know what I mean by shiny object? So whenever Microsoft releases a new shiny object, Power Platform, CRM, whatever the new thing might be, marketing automation or CE, marketing, whatever, all the various new things that come out, and then that gets pushed into the channel. That also is a distraction. This is where these mixed models get themselves in trouble. So typically, it's not something the management teams look at. It's not something the management teams and partners spend time thinking about. When they do see it, they think, crap, you're right. Never thought of it that way. And so it gives them a cause to pause, right? And then, you combine the fact that they're working hard, plus there's a constant barrage of new sort of shiny objects going by them. It's no surprise that they're not focused on this part of the business so much.
And the other thing I would say is that it's not automatic, right? I mean, you have to put effort into defining what path you want to take, identifying which path is likely to be the most successful for you, given the configuration of your business today, and then, actually put together and work a plan. If you don't know where you're going, then almost every path will take you there or nowhere.
It is interesting. It suggests that there are a lot of partners out there who haven't done that planning for 12, 24 months or 5 years of where they think they're going versus where they think, especially those really committed to the Microsoft business. Like you said, just heads down and focused on what's quarter to quarter kind of focus.
Well, I think right now they're focused on end of June, right? Because of course it's Microsoft year end. That's the big focus. If I was going to be critical of management teams, I would say not enough time is spent with that question. The question of what could hurt us, what structural changes. A lot of the stuff that we found in this year's study are long-term structural impacts that will just kill you by 1,000 cuts over time, right? And if you're not actually paying attention, if you're not actually asking those questions at a management team level on a regular basis, it's rare that you would get to the answer. That's just the thing. And I'm not actually being critical of people running these businesses, because they're doing a great job. They're delivering good customer service. They're making customers happy. They're keeping employees, on board. There's all kinds of complexities with that. But it's one of the things I think we cheat ourselves at in this business, and that is cheat ourselves of the time for management teams to really examine what could really hurt them. And I think we're just seeing some of that stuff right now coming out of the research.
Well, I did want to move on to one of those maybe more structural market type issues, which is resources in this particular channel, in this particular industry. And I've heard you talk about this a little bit. Can you give us the overview of what the resource situation is today?
I mean, the research situation is, and this is another one of our sort of, I would call it ecosystem-wide challenges, right? There's not enough effort. There hasn't been enough effort over a long period of time to recruit people into our business. It's not what I'd call the most exciting business to be in, right? The ERP business. Now, when you combine the fact that there's not been a high recruit or a high, what I'd call effort to bring people into a community, and you combine that with what we call the Great Resignation, from the pandemic era, right? And the aging out. So we've got three factors there. Our average ages, the median age, I think, was 49 in the senior positions coming out of the study. But that doesn't reflect the owners, right? The owners are actually, in an older category. We have a case now where we have a very short supply of ready-to-go skilled consultants. They live with a competitor. And that what partners think they should do is try and hire that resource from a competitor by paying them more. Now, this only exacerbates that problem, Jason, of the EBITDA, because once you pay them more, then you have to automatically increase the bill out rate, which partners don't do. They don't have a direct correlation to that. And because they don't do that, it drives the profitability down. That's what's reducing, one of the pressures on the reduction of the services margin. That's one of the things that results in that. So we have worldwide, there's been a constraint in terms of labor for the last 10 years. Everybody would say we were short of labor. The pandemic has exacerbated that by people, resigning and retiring. And then we added to that customers that didn't do projects, right, during the start of the pandemic, that all lit the projects up towards the end. So we've got a very strong demand for the services now and a very short supply of resources, both today and going into the future.
Yeah. And unfortunately, that capacity, doesn't appear magically overnight, right? It takes time to build that capacity. And as George has said, we haven't had a particularly, I would say, good focus on that historically. So we're kind of landed in this situation now. And I think the other thing is that there's, the delivery model has basically been tending towards more bespoke solutions sort of traditionally. And while some have made a better effort in repeatable business processes, templatized implementations, things like that, not enough have to ease the capacity crunch that we're seeing now.
And where do you see this challenge going? Do you have some likely scenarios that you foresee?
If you look at it, it's almost like Microsoft intermittently, right, wakes up to this reality that the channel is a constraint to them selling more software. So they get invested in, we need to build capacity. So there are some initiatives now worldwide within Microsoft itself that is really looking at how do they help the community build capacity, right? There's a number of, like, the way that we would solve this going forward, if you think about this, as one of the ideas that we would have, is that if Microsoft if Business Central, for example, was the software that, accounting students learned accounting software on in schools, we would automatically increase worldwide, right, our capacity of people that knew the product. Now, this was a strategy taken years ago by Sage and Intuit and a few other companies, and they got their products deeply embedded in school systems. This is something where Microsoft's playing catch up. So we have an issue where the talent we need, in the formative years, 16 to 20, right, where they're learning different things in school, we're not really getting them sort of invested in the technology or knowing the product. So we have a shortage coming right out of school. And then secondly, Microsoft has to be a player in this, right? It's not, no single partner can solve our labor constraint on their own. The problem that we have with labor is an industry problem. And we're trying to solve it with a single participant, like a single partner in that community. That can't be solved that way, right? It's going to have to be solved with a long-term strategy in terms of integration into the school systems, one thing. And then a more structured program that can be rolled out across the recruiting, campuses across the world, right? Where we can bring people into our world, right? And get them productive and interested in what we do, so that we can solve this labor problem over the long term. There's no short-term fix on this. There are some partners doing really well at this, the recruiting from universities. So we know that it's viable. There's just not that many. And it's really hard to do if you're a small partner. You would not have the resources to do it. So, that's one of the things we think about. Strategically, Microsoft has to get involved. We have to make Business Central or finance and supply chain the product. If you're going to be a master's in accounting, you have to learn accounting software. Learn that one. Right? If wherever you have to learn those applications, let's learn those in school so that we automatically have people that are familiar with that. That was a great strategy for other products. I think we could benefit from that in our ecosystem.
Yeah, I recall seeing years ago now, my time in this space goes back almost 14 years. And I remember early on seeing very impressive sort of meetings and lunches around events that were academic alliance and hearing some very promising stories. And I feel like that really has tailed off. I think part of that's maybe just Microsoft's own focus, perhaps falling away from that, as you said, and probably to the detriment of those students or, of reaching those students in various countries.
Yeah, it's something we can't do, Jason. It's something that no one partner can do because the amount of resources to produce the learning curriculum, right? But once you have it, you can reproduce it, right?
I guess another thing kind of related to resources that I had noted, and maybe you can help me understand this, but I think you also found perhaps that utilization within partner organizations is also going down. So for the resources that they do have, maybe this is related to some of the project delays you talked about earlier. Can you clarify on that?
Yeah, one of the key, so utilization has significantly dropped, right? We're seeing very few partners who drive out billable hour counts per resource in excess of 1,200, 1,300. It's now below 800. And, one of the big driving factors there is just smaller deal sizes. As the overall demand for cloud solutions has evolved, the average deal size has declined. And it's just more difficult to get high levels of utilization when your deal size has contracted as much as it has. So that's one of the key driving factors behind the utilization equation.
And I would add to that, right, is indivisibilities, right? So what happened is we went from, if you go back a long time, right, a consultant could deploy NAV by themselves, a single consultant. As we've added complexity, both in functionality as well as the tech stack, right, we've then made it so that no longer can one person do it, right? In order to complete a project successfully, you might need 2, 3, 4, 5 specialized resources to make it happen. And if you don't have enough volume, you can't keep them busy. right? It's one of the interesting side effects. If you think about the early days of the cloud world, when people were abandoning sort of Business Central or NAV at the time and running to NetSuite, one of the unintended consequences was those partners were used to high utilization, but with the average service value in NetSuite being so much smaller, it negatively impacted the utilization. In fact, a lot of partners that ran there ran back away from it, right? They never built big practices around it because you couldn't, right? And so now that was a lesson that we learned a long time ago. We just didn't think that would apply to Business Central. I think that a lot of partners didn't think that, but that's exactly the case. The smaller the easier the software appears to be, that's cloud-based, right? Then the less attach of services, which means smaller service deals. Now, it's not universal. There's still some large-size services deals around Business Central, but to the degree that average service value has fallen, then it impacts utilization. Now, you combine that with paying more for that resource and lower utilization, and bingo, you have the negative impact on services margin and overall EBITDA.
Yeah, and the final sort of piece of that, services profitability puzzle are charge out rates, as George mentioned earlier. And, there's room, we feel, for, and a necessity, obviously, given falling utilization, for a raise in charge out rates. But unfortunately, the factor on the other side of that equation is the customer's willing to pay, right? And that just only allows you to raise charge out rates so much before you hit that resistance.
Yeah, it's a complex combination of factors. Sorry, go ahead, George.
I was going to say this because I got to get my plug in for this, Jason, because if there's partners listening to this, let me say it clearly, really clear. You're going to have to raise your rates this year probably twice, right? If you don't want to do a big price raise, you're going to have to do at least twice this year. And that's just the fact. Let's take just that labor piece out of it. Take the fact that we're overbidding for labor now, but the fact that inflation is hitting us. I'm saying universally across to all of our clients, you got to get on the rate raising, January and July, or you have to do a big one, right? Because our costs are all going up, and we'll feel it next year in our financial statements, then adjust our rates. And my recommendation is adjust the rates now. Don't wait, right? Get your rates up 3%, 5%, get them up.
Another area where, Dana, I think you touched on this a little while ago, and I wanted to get more perspective on it, was the impact of marketplaces. Microsoft, obviously, for the business app space has AppSource, something we could debate in various ways about what that's really been doing, if in the various ways it was intended to work. But you certainly see some important reasons why partners need to pay attention to it.
So there is generally, obviously, a tendency on customers to look to buy software increasingly either from publishers or from aggregators or from marketplaces. And so, to the degree that happens, and it is an increasing phenomenon, it effectively disintermediates the partner unless they're able to add significant value in the form of their own IP, for instance. And, George has done some just some further analysis in that area in terms of the potential impact that marketplaces in particular could have in terms of disintermediating partners more significantly.
The thing is, and we got down this rat hole just looking at, structural changes. And then the forecast from Forrester came out and said it's going to cut, through partner sales of software by 50% by 2030. So I thought, okay, well, that's, if you cut it by 50%, well, what does that mean, right? What does that actually mean? Well, if you think about, if you cut license sales, if you take the median partner, if you cut their license sales in half today, that would mean their EBITDA would be a decimal point. So it would not be even 1%. It'd be lower than 1%, because what's happened with subscription revenue, right, is it's actually, with subscription revenue, licensing makes up a larger percent of the P&L than in perpetual, right? So what's happening is we're increasing the percent of revenue that comes from licensing right now. That's where we're sitting. At the same time, where we're going to see a bit of a collision where marketplaces will eat some of that away. Now, if we took half of that away today, we'd be basically insolvent as a partner ecosystem. The median partner would be, right? And then that's even in the absence of the fact that our margins will continue to decrease. So we're going to get less licenses and we're going to get a lower margin, but take the lower margin out. If we just kept the same margin in 2030 as we have today, you'd still be break even as a partner. The median partner would be break even. So marketplaces are to me one of those ones. It's a structural risk, and it's a structural risk because I don't have line of sight today when I sit here to say this is how a single partner can solve the marketplace issue, right? There is no good answer, right, to that, because to solve the marketplace issue as a partner, you'd have to be able to invest in it and create your own. And that's not going to work, right? So this is a structural ecosystem problem that left unattended will be very painful for this community over the long term.
It's very similar to the capacity crunch situation, right? I mean, between that and marketplaces, those are two major forces literally bearing down on the ecosystem as we speak.
I don't know if this relates, but there are distribution partners that have their own marketplaces, right? Where they sell Microsoft solutions and they sell all sorts of other IP from vendors. Does that factor in when you talk about marketplaces? Or are you really thinking more about the publisher's own marketplace?
Well, this is where I get suspicious. This is where I get a bit of a thorn under my nail on that one, right? Because you are correct. The distribution partners do have market. And those marketplaces are such that a partner could literally put a marketplace up, right, on their own website through a portal that would allow customers to buy software from it, provided that they bought it from that distributor, right? So in other words, in order for you to use that facility, it means you're going to be committed almost exclusive with that distie. It's not an exclusive agreement. I realize that, but you're not going to have multiple portals. So your customer say, I want to look at tech data today. I want to look at Pax8 tomorrow. And I want to look at Ingram, today as well, right? They're not going to be doing that. You're going to make a choice of one. Now, as soon as that happens, I believe, Jason, then we will start the accelerated erosion of margin to partner, right? Because right now, the great share shift is going on, right? Microsoft wants people to go through tier 2 distribution, right? As that occurs, that means the distributors are being very generous with partner margin today. But we all know, they will all say, you're right, we won't be able to do this over the long term. That means margins will go down. So I think there's a risk if we rely on the distie or the distributors to provide the marketplaces only. I think there's a risk to the community.
Yeah, it's yet another component, a really important component of planning for the longer term. If you are a partner today, is how you're going to kind of face that reality going forward. And I guess one other thing that's kind of been in the back of my mind as we've been talking here is the other element of this whole system, which is Microsoft itself. I think back to their recent earnings report. Dynamics is doing really well. It's one of the things that they call out now in earnings calls. It gets into the announcements themselves. So is there some sort of disconnect between sort of this pain that the partner channel is sort of experiencing and bracing itself for, as you sort of see it, and what Microsoft's interests are in the short term and the long term?
I think this is just my own opinion, and this could be because I've been around the ecosystem too long. I would say that Microsoft, since the advent of OCP, One Commercial Partner, has created a what I call an alienation factor within the partner ecosystem. Dynamics, if you rolled this back even 10 years, right? There were PAMs in the field, there were partner technical specialists, there were partner marketing managers, there was a resource pool within the Dynamics community funded by Microsoft that helped everybody drive the business, right? And so over time, as Microsoft, as Dynamics got more integrated into the greater Microsoft, then every product is viewed the same. It should all go through distribution, and that's okay. Biz apps, I might argue, is differently. But as you move to distribution, then you provide separation between the software publisher and the partner. So right now, I would say we're heavily under-resourced by Microsoft. Now, I have heard rumors, within the Microsoft ecosystem that 2023 will see a return to more investment in partners and more investment in SMB, because, at the end of the day, Microsoft can only be as successful as they can implement software. And that's partner driven, right? So their Dynamics business is doing very well. That's a positive thing. It's probably the best time to be a Dynamics partner ever from a marketing perspective, because Microsoft's doing well. The pandemic drove Microsoft up to better heights, and then the awareness of Business Central and the other Dynamics product got dragged along with it. So from a market perspective, it's great. But from an investment perspective, Microsoft's investment in the actual partner community has shrank dramatically from where it was 10 years ago. It's down significantly, and I think that we're not going to. They can't be an absentee owner, right? At some point in time, this whole partner community and how that grows and how we recruit and all the factors we're talking about here
are going to have to come back and be reckoned with by Microsoft themselves, right? Because this won't solve itself.
Yeah, interesting points. And, you think about all the, as you were saying that, I was thinking about all the sort of the product pain that Microsoft itself went through and sort of put the partner channel through with various products to kind of get where they are today, which I would argue is a much more comfortable and sort of stronger place product-wise. And it is sort of an interesting clash that, as you said, there are these points of risk now that maybe weren't there before they sort of started this cloud journey and really sort of stabilized it to where it largely is today. All right. Well, I guess the only other thing I was really thinking about was feedback that you're getting from partners as you've kind of put this message out there. I know you've presented it in at least a couple of different venues, if not more. Anything else about what people are telling you in response to some of your findings?
Yeah, I think to George's, earlier comment, a lot of partners really just haven't historically taken the time to sort of step out of the business and think about how they can drive the business forward. So probably the biggest reaction is, we have to put some thought into this going forward. We can't just kind of tweak the existing business model and hope that it'll magically somehow self-correct and become more profitable again. Maybe it's time to look at the three paths to profitability that we've talked about and figure out which one might be the best bet for us and how we might go about executing on that. I'd say that's probably been, from what I've heard anyway, the biggest feedback from what we shared so far.
I've had quite a bit of feedback, Jason. Like, I like to walk through the numbers with partners and just talk to them about it. Like, we did an analysis. If you look at the median number of hours billed, right, by a professional resource, and let's say, for example, because my other argument here is we're not going to be able to sell billable hours forever, right? And the reason I say that is because, $110,000 resource, say you paid somebody $110,000, at the current utilization rates, when you add their benefits together and the utilization rates today, you end up with a charge out rate in order to be profitable, like double digit EBITDA profitable. And I'm not talking 50% EBITDA. I'm talking like 12, 15, right? That charge out rate would have to be $358, right? And partners are like, oh my God, I can't sell it at $358. And I'm thinking, that's my point, right? So we can't continue to pay a consultant, I'm not saying overpay, but we can't continue to pay these high rates for consultants and have a low delivery of billable hours. We're going to have to change that model because, I don't know about you, but when somebody wants to charge me $350 an hour, I sit up straight and pay attention to it, right? And so I think it's going to be harder and harder to sell our services by the hour. I think this is going to exacerbate this problem. So, we think about this whole cloud first solutions. The more templatized, the better. This is not news that we've said this before, but in a way that we could say the project will cost you $70,000 and get away from the billable hour. If we could do that, we could also turn the corner on profitability, right? But because we're stuck in this billable hour trap, we continue to, people get guilty. I don't want to charge them $350 for that bit of work. We get guilt with our consultants. We got resistance from the customers. We got a number no one's happy with. I think, that particular issue is going to have to be looked at. Either you're going to have to be very comfortable with those rates. But I mean, if $110,000 consultant's $350 an hour, or at that utilization rate, then your managers who you're paying $175,000 a year are going to be $700 an hour because they're billing fewer hours, right? Those are going to be really tough hours to sell, right? And this is how we continue to drive down profitability here. So, when you start talking, when you just take that one resource, 110,000, and have that conversation with partners, then they have a real, aha moment. It's like, wait a second, you're right, we can't sell that. And even earlier on the call, Jason, I said every partner should raise their rates twice this year, and people will not like that. They'll react negatively to me in that, right? I know one of the partners we worked with this year raised all their charge out rate $30 to $40 per hour across the board, right? Because they had to, because to keep the people, they had to give them raises, and that's just what they had to do to make money, right? So it's one of those. It's a tough part about our business. The problem is we all like the business. We like doing what we do. We like working with the customers, and so this money challenge tends to be an awkward conversation with customers. But you have to have it. You have to look at it and just say, this is an act of insanity. We keep doing the same stuff over and over again, and we expect a different result. But for the last 7-8 years, it's proven that we're in a downward trajectory for profitability, right? And that'll mean nobody does well.
Yeah. And Jason, I think the other sort of major thing that we've heard in terms of a reaction, profitability very clearly, as George has described, but also valuations, right? If you think about, most owners are in their 50s and, looking to potentially retire at some point. Their business is a key component of their retirement plan. They're going to have to monetize it somehow, those 20, 30 years of effort. And, in the face of declining profitability and all the other macro pressures we've been talking about, a lot of owners are starting to go, okay, well, what's my business going to be worth, in when I want to retire, and how do I go about, making it worth enough to support the kind of retirement that I want, right? And when you do the math and start to get into those kinds of conversations, you often find there's a discrepancy between what the owner, would like the value of the business to be and what the value of the business actually is and is likely to be, down the road, given all these forces. And so there's, there's another sort of aha moment often getting in there going, oh, I'm going to have to do something concrete here in order to really engineer and arrive at, a liquidity event that I'm going to be comfortable with and happy with.
Yeah, big challenge. I can imagine it weighs heavily on some owners' minds. All right. Yeah, really interesting and really complex. Great talking about this stuff. Is there anything else that you wanted to mention today? Anything else that perhaps you're working on or that you're looking forward to? I know we're right up on with, I'm sure many of your clients are, we're right up on the end of Microsoft's fiscal year here coming up quickly. Any other thoughts?
One thing I'll say is that, with things that we're working on in terms of deals, mergers and acquisition deals, we're seeing the impact of the risk of stagflation in the space now. We're seeing that the offers in the last, month have changed in their complexity. And when I say there's less cash up front, there's more earnout, there's more contingency payout as opposed to 6 months ago. It's like, every 7 or 8 years that this industry undergoes a structural shock. We underwent the cloud shock, we underwent client server shock. We've undergone a number of structural shocks over the history, right? And I think right now, we've had a big, solid, positive ride, and I think we're in for a little bit more structural turbulence. And that will affect the way companies are sold, how they're valued, and how they're paid for. Saying that, I must admit, I'm really hopeful that come July 1st, we get a lot more investment in the partner community and in SMB, right? So that's one thing that I'd say that we're looking forward to. Like I say, it's been a great year to be a Dynamics partner because of the demand. And if we could just translate that demand into bottom line success for partners, I think we'd all be a lot happier.
We certainly would.
Well, I think we can end it there then. George, Dana, thank you both so much. It's been a lot of fun talking to you. Really interesting topics that you brought up and a ton of complexity and things to watch for the future.
A pleasure being here, Jason.
Thanks for having us, Jason.
And that's it for this episode. My thanks again to Dana Willmer and George Brown for joining me. More information on their work can be found at partnereconomics.com. And to reach me, send an email to jgumpert@msdynamicsworld.com. And for all of our updates, please do follow us on LinkedIn and on Twitter. Until next time, this is MS Dynamics World, signing off.